Happy Mother's Day, economic students. We're now in week 4, and this week we're going to look at all the market structures. We're going to look at perfect competition, monopoly, monopolistic competition, and oligopoly. And looking at for this week, you're going to have a forum discussion, you have your cost paper, and then also the homework problems associated with those chapters. So looking at the market structures, kind of this week we're tying everything together. In previous weeks we looked at how the firm looks at production efficiencies and looks at the cost curves, and now it looks at, based on these things, what is my market structure? Do I have a very inelastic demand or a very elastic demand where consumers are very responsive to price because of a lot of substitutes? And we look at kind of the profit maximizing conditions for each market structure. And to start off with, like, perfect competition, we look at the characteristics. You're a price taker, there are many competitors in the market, information is everywhere, and essentially you face a perfectly elastic demand curve. Now what that means is that each additional revenue you get every time is always the same. It's not a downward sloping demand curve. But the perfectly competitive firm is still going to make their maximum profit at the point where marginal revenue equals marginal cost. And that's going to hold true for a monopolist, monopolistic competition, but not necessarily for an oligopoly. A lot of times they make interdependent decisions. But what you're going to see in these chapters, it's going to ask the question, well, where is my price in the market relative to my cost curves? And specifically, where is the price relative to average total cost? If the price is greater than average total cost, you're making an economic profit. And if you're a perfectly competitive firm, you should expect others that are entrepreneurial in nature to move into that market and eat away at those economic profits until we just get back to a normal rate of return or a normal profit. If you're somewhere in between, if you're at just at average total cost, if price is exactly equal to average total cost, again, we're assuming at that average total cost you're covering both those explicit and implicit costs. You're just making a normal rate of return. And then finally, if you're in between those two things, if your price is below average total cost but above average variable cost, you got to remember that difference is your fixed cost. The decision is continue to produce in the short run, so we at least cover some of those fixed costs. And then finally, if your price is exactly at average variable cost or below average variable cost, that's what we call a shutdown point. And that's where firms have to make a decision that we no longer want to offer this product line or this particular service. If things are really bad, it means we go bankrupt, we become insolvent, we're just no longer in existence. And again, kind of thinking about these profits, firms do try to maximize profits, and with this marginal revenue, marginal cost, when you read the textbooks and the theory, it kind of gives these examples sometimes. It's like, whether do I produce another car or another earring? Well, it's maybe not necessarily that we're looking at very specific items, but it's business decisions about, I'm thinking, hey, I'm getting some additional revenue from taking on this activity, but how much did this, say, the additional cost from taking on this activity? If I'm a farmer and I pay for somebody to fertilize my fields with a helicopter, that's a cost incurred, but I'm also expecting I'm going to get more output and more product from the wheat, corn, whatever it would be. So I'm making marginal decisions, and that's a lot about what business does, is it makes those marginal decisions. Is it worth the extra time and the cost? Is it going to be profitable for me? And I'll do so as long as I believe it is going to be profitable. Okay, so one of the things with monopoly, that's like the other extreme when there's only one entrant in the market. They face a downward sloping demand curve, but they're still going to make that same marginal revenue, marginal cost decision. But we have to remember that we have to go up to the demand curve and across to find the price. And it is possible for a monopolist to earn economic profit in the long run. Typically, utility companies are good examples of monopolies that are regulated. They allow them to earn a normal rate of return, and they usually have to go before regulatory commissions to say, okay, if you're going to be the sole provider of natural gas in this area, we're going to make sure you're regulated and will allow you to earn a normal profit. Monopolistic competition is probably the most prevalent market structure you see out there. I like to think of it like the fast food restaurant. You have your hamburger, you have your soda, you have your French fries. It's homogeneous in the sense that it's food, but we all try to, say the firms, they try to do things to differentiate themselves, to try to make themselves unique. And they may offer other services too. And they also spend a lot of money on advertising to kind of shift your demand curve out for their product or service. The last one with oligopoly, this is typically where there are just a few firms in the market. Requires a great amount of capital to get into this market structure. It's very hard for startups to get in this. And then in terms of their decisions, they're oftentimes, they still think about marginal revenue, marginal cost, but they oftentimes also look at what is their competitor doing. So if I do this, should I do this too? Or if do I wait until this airline raises the prices before I raise the price? Or do I dare try to raise the price, because if I do, all of a sudden I see that I'm losing market share to my competitors. Okay, well, to wrap up some things this week, I want you to think about, in terms of profit too, I put a link out there in the mini lecture, the Word document, and it was from CNN FN. It talked about some of the 10 most profitable companies right now. And they had Exxon, Walmart, and Apple. But one thing I want you to remember, this is in nominal dollars, so it's in total dollars of profits that they made. One thing we have to be careful with, and you'll see in the media that Exxon made these huge profits. Well, they do make big profits, but you have to look at it in terms of how much was the value of their shares outstanding. What was the market capitalization? Maybe for an Exxon investor, they really only made a 10% rate of return. There might be other companies out there, smaller companies, that would have made you a much larger percentage rate of return. And that's what we're kind of referring to as economic profits, is that you're exceeding investors' expectations. But take a look at that link. I think you'll find it interesting at least. And we'll have a little bit more of a form discussion to have you think about what firms are using these days in terms of technology, kind of track your buying behavior and get your opinion on it. But it's a method or technique to try to ultimately increase their profits, try to anticipate what you're going to be buying in the future. So enjoy Mother's Day, have a great week. But again, if you do have any questions, make sure to email me, and I will talk to you online. Take care.